Hello, my name's Jamie Lee, and today I'm going to be doing a financial health check on Coca-Cola using the driver framework: define, represent, implement, validate, evolve, and reflect. And I'm going to focus on growth, margins, cash generation, and the overall 2025 outlook. And all figures are from 2024 versus 2023, and yeah, let's get into it. So, first thing, here's a quick headline. Revenue is in 2024 was about $47 billion, and up to 3% year over year from 45.8 billion. Comparable operating margin expanded to 30%, up about 90 basis points, even though the GAA principles margin fell because of the non-cash charge. On cash, free cash flow, excluding a large IRS deposit, came in around $10 billion, which easily covered $8.4 billion in dividends and about $1.1 billion in net buybacks. So top line is growing primarily based on price and mix margins and are resilient on a comparable basis, and cash returns remain very strong. All right, so for represent over here, the plan for so confirming from 2023 to 2024 headline numbers. Second, compute simple year to year changes in margin trends, both GAAP and comparable. Third, evaluate cash generation and capital allocation. And finally, close with guidelines of and key risks. For growth, we're looking at the net revenue. So revenue moved around, like stated before, 45.8 to 47.1, and that's roughly 3% growth, stated again, and driven mainly by pricing and favorable mix rather than big volume gains. So a slow increase over time, and unit case volume up was 1%, while price was up double digits, around 11% for the year, which is really good for a company with that generates this much revenue. And the takeaway is that Coca-Cola is exercising prices power with materially hurting demand. So for profitability and the GAAP versus comparable, we're looking at two views on margin, and on the GAAP basis, operating margin fell from 20 around 25% to 21%. But that decline is explained by the non-cash, roughly $3.1 billion Fairlife remeasurement charge and currency effects. And on the other comparable basis, which strips out the noise, operating margin actually expanded from 29% to 30%. And that's really important because it shows the profitability improved, even though that inflation and the headwinds. So reported under GAAP, it looks weak, but in reality, underlying operations look a lot stronger. So when it comes to cash generation, so cash from operations was about $6.8 billion, as you can see, for 2024, depressed by a one-time $6 billion IRS tax litigation deposit. Reported free cash flow is about 4.7 billion, but if you add back that deposit to see the normalized picture, FCF was about $10.8 billion, as you can see on this chart. On margins, CFO margin was roughly 14%. Reported FCF margin around 10%, and normalized FCF margin was closer to 23%. The capex was around $2 billion, and what we can take away from the, oops, what we can take away from this is that the cash engine is strong, but one-time deposit just masks it on a reported basis. Where were we? So for the capital returns, here's how that cash was used. Dividends paid 4.8 billion in 2024, which is roughly, I mean, it's 78%, so roughly three fourths of the normalized FCF. Net buybacks were around $1 billion, and they raised the annual dividend from $1.94 to $2.04 in 2025. And what that does is extend a very long dividend growth streak. And the mix here says that Coca-Cola prioritizes dependable cash returns. So with buybacks as basically just a secondary. And then when we look at the 2025 outlook and what we think is going to happen. So for 2025, management guided to organic revenue growth of roughly 5 to 6%, which is a 3 to 4% currency headwind for the net revenue. And the organic trend does look great. I mean, it looks really healthy. And I think what is needed to watch out on, though, is the regional mix and some category softness last year in areas like sports drinks and coffee. And I cross checked these numbers against the investor materials and the 10K press releases. So I research on, and the big reconciliation item here is separating the GAAP principles from comparable results to understand the overall performance of the company, and that's why I emphasize both views throughout. Um, so now I like to compare Coca-Cola um, to PepsiCo and Dr. Pepper on just a multi-year growth. So comparing these, I'm going to compare and test how durable the moat is, and I'd also layer in debt profile and FX scenarios to see sensitivity around 2025 guidance. So, my opinion at all this and all this data, what I can take away from this is that Coca-Cola's global brand portfolio gives it consistent pricing power and cost leverage. So the comparable margin at 30% is impressive for consumer staples, name and growth reliable dividend growth. I'm constructive on long-term cash generation, and the risks I'd take a closer look on is the unit volumes in developed markets and regulatory pressure around sugar. Um, what's good is that the premium adjacencies like Fairlife can add growth if they continue doing well and maintain margin discipline. And yeah, this is a snapshot at the appendix table. Let's see the deposits and the different percents of who gets what. And this is my code up here. So and yeah, just remember the story flips depending on which lens you use. But I'm happy to talk to everyone about price mix versus volume and how it may change during 2025. And thank you.